Good morning, everybody. Thank you for joining us on a Saturday morning. And it's on a hot topic, so I'm sure you'll find it useful. Well spent Saturday morning, hopefully. I have with me my partner, Bhavana Acharya.
Good morning, everybody. Welcome.
So this, initiative by us is essentially to select few who had shown interest when we gave our call on the Quant mutual funds, Quant AMC. So we thought it right to kind of explain our call further, since you've taken the effort to read it up and register with us and read it up. So before going into Quant, we thought we should kind of try and explain the categories of risks essentially that you go through when it comes to mutual funds, right? So with mutual funds you have the market related risks, as they always say, which is nothing but the performance risk, I mean the volatility risk. Fund can go up, can come down, etc. When it comes to equity, it is the risk essentially is triggered by market moves, earnings, macroeconomy and all that. When it comes to debt, your interest rate, the credit risk, and of course, there is also liquidity risk when it comes to debt. The second component of market risk that many of us miss out is the uh, what we call as liquidity risk. The third component in mutual funds, which just transpired, is the governance risk. I'm going to take a bit of time to explain the liquidity risk and the governance risk, and of course, parallelly draw examples from what has just transpired or the risk that we see in quant, right? So the first part on the performance risk, on the market risk is merely the volatility. The second part of it is the liquidity risk. There is also, I'll dwell into liquidity risk, but before that, there is also one risk that you take, which is the active fund management risk. When you decide to go with active fund management, there is always the risk that um, you may choose the wrong fund manager or your fund manager underperforms, etc. Right? So that is another risk. So there is market risk, there is active, fund management risk, and then there are governance risks, right? So the first part, market risk, is one is the volatility, which is par for the course in any market related instrument. The liquidity risk. Liquidity risk stems from stocks having low float in the market, right? That is, the turnover is not very high. So what happens when I start buying a stock that has low turnover, low volumes, etc.? I The stock is quite sensitive to my purchases because I am a big purchaser. I'm an institutional purchaser. I'm a mutual fund. I go and buy a few thousands, a few lakhs of a share. The share price actually goes up, right? So what am I doing? By buying into a low liquid stock, I am kind of pushing its price in the hope. So the stock is going up and there is a hope that this institution is holding it up, either by buying more of the stock or just holding the stock, it's holding up. And what happens when this institution withdraws? The stock doesn't find support, there aren't enough takers when it decides to sell, because the stock never had much takers in the first place, right? So and therefore the stock price, the stock is sold at a lower price and the price starts crashing. So this is the influence on stock price and therefore on your NAV when a stock has low float, right? uh, Combine this with a strategy that a fund may use. If a fund has a long term strategy, it buys, holds, and so on, slowly the stock might gain strength from other institutional investors investing and so on. But if a fund has a momentum strategy, that is, it is going to buy, and it when a fund has momentum strategy, it is going to buy stocks that are moving up. What does that mean? So you buy an illiquid stock, you move it up, and because you move it up, here is a stock that has good momentum, and therefore you buy more of it, right? So this is a loop. So this is the biggest risk in a stock with low float. And for hedge fund houses, AAF, those risks are par for the course. These are people who enter into such funds knowing the risks, but not mutual funds. And that is why this is a double edged sword. When it comes to fund houses who are using momentum strategies, who are trying to pick stocks that are moving up, putting more in stocks that are moving up, and they happen to be liquid. So this is where the risk stems from, and that is the biggest risk when it comes to any flight of money for the mutual fund house or for the stock itself. If an institution decides to withdraw out of that stock, they have to do in a very, very, very gradual manner. They cannot afford to hit it in one shot and think of exiting. So this is in general the risk. The third kind of risk, the second kind of risk I already spoke about. I'm not going to dwell much into it. Active fund management risk. The third kind of risk that we are going to talk of is the governance risk, right? So when I talk about governance, governance could mean many things. Governance could mean lack of a proper process or system in place to monitor your stocks. It could be a lack of a proper strategy in place, which a mutual fund should have, right? It could be fraudulent trading activities, or not fraudulent but not known to the AMC, but there are undesirable activities happening. All of these can be governance issues, right? Even when a policy is not followed right, it can be a governance issue. Supposing a fund is supposed to have only in debt stocks with low average duration, and it increases its average duration, or it increases its credit risk, that is a governance issue, because there is a policy in place and you have breached the policy. Now a trustee is supposed to make note of all these, and of course there are periodic SEBI audits. SEBI is also kind of looking into it. Now, specifically coming to front running of stocks, most of us think front running basically benefits from some XYZ person, as in somebody knows information that a mutual fund is going to buy, therefore they buy ahead. And when the mutual fund house buys, especially in a liquid stock, large quantum, the price goes up. And because this person has bought ahead of the mutual fund house, they tend to gain, because this AMC has kind of moved the stock price. Because you entered earlier, you tend to benefit. So this is what generally people think as front running, and it's not just that. There are two ways in which front running can happen. One, what I said just happens. What's wrong with it? Quite a few things, and which is what SEBI frowns upon. One, just because this person who's taking position is not going to take very tiny positions when they are in the know. They would have actually, especially in a illiquid stock, they would have upped the price, they would have moved the price already a little bit. So they are getting an undue advantage over the institutional investor. So the institutional investor could have entered at a lower price, but for this person already pushing the stock price up. That's one thing. The second and very important thing is knowing that it is a liquid stock, knowing that the institutional order will up the price. A person who entered earlier may have entered earlier and will be selling it back to this institution. So what are you doing? Basically, this institution is going to buy X quantity. I will buy ahead, and when they are demanding, because it's a liquid stock, they're not going to get a large quantum, so I will sell it to them, and when they demand a large quantum, the price will move up. I will sell it to them at a higher price, right? The second one often happens, especially when the stocks are illiquid, or when the momentum strategy is used, because your idea of a momentum strategy is buy a stock that is moving up, right? And many of us think momentum index funds, or funds that call themselves momentum, use momentum strategy. That need not be the case. All you have to do is not, you needn't know the strategy per se. You can go and look at the portfolio turnover of funds. Very high portfolio churn steadily. See, sometimes new fund manager can come and churn the portfolio, so you'll see a sudden spike in portfolio turnover. But steady high churn in portfolio is a clear case of momentum strategy, right? And that has been the case in many of the funds in quantum mutual funds, right? So therefore, there is a higher possibility of these kind of events happening in those kind of portfolios, right? Many of you asked us, this can happen in any AMC. You're right, it can happen in AMC. But what happens if the entire strategy of a fund house is to, have the, a high churn, and therefore buy higher momentum stocks, and, the price moves up? To top it all, many of us investors all around, have put in money into these funds, right? So there is a constant inflow, and the fund house has to deploy those inflows as well in their own stocks, because that's a sure short way to kind of also use their strategy. Stocks are moving up, I will put in those stocks again. So they are moving their own stocks oftentimes, right? So, and that is where the risk is higher. If you had been an existing investors in quant and you had received this huge inflow that quant had caught, you would have benefited, not just because of the inflow, but these inflow would have pushed the price of the existing stocks, because these are sensitive stocks. You buy more, price goes up, and you were already holding units, so your returns, so you really don't know how much of your returns came from the strategy itself or came indirectly from the inflows that are pumping up these stocks, right? Just as you benefit while you stay, while you are an early entrant in these fund, you also tend to lose when there is a withdrawal, right? So when people start withdrawing, you have to sell these stocks, and if the stock happen to be, illiquid or etc., it hurts. So the thing with governance, many of you have said, but they have liquidity. There are enough large cap stocks. 50% or 55% was stated by media as holding in large cap and cash. What is the risk of liquidity? I mean, if there is a run in money, and these kind of stocks are the ones that are sold, the liquid stocks, then what is a portfolio left with? A portfolio is left with poorer quality stocks, right? That's not something that many of us think about, right? So, governance risk does not come into light unless it has fully transpired and it has hurt you. So it is very natural. I mean, the performance, the first point that I said, volatility risk, etc. When the performance goes down because of market, naturally, I mean, most people want to think that you will stay only with performing funds, and you tend to kind of exit. Similarly, in active management, when a fund manager is not performing well, there is a tendency for you to think this fund manager is not doing well, I'll exit. But when a fund is performing well, from its bottom, when the market bottom, to the continuous rally that we have seen in mutual funds now, especially in a momentum strategy, there is no reason to believe that a fund cannot perform more. So when there is performance and there is a risk, right? This is a balancing act. So the question is, if you had entered these kind of funds, or if you have any of these risks for that matter, whether it's market related risks or active fund management risk, or when it comes to governance risk, how do you mitigate them? You cannot entirely avoid them. How can you reduce the risk? Now, this is something that I think Bhavna will talk about now. Over to you, Bhavna.
Yes, Vidya. So that was a recapping of the kind of risks that you see in mutual funds. Now, before we get into how to mitigate them or manage them, just a reminder: if you have any questions, just put them in the comment box, and we'll get to it once we get to the end of what we are saying. So, how do you manage risks in your mutual funds? The first point, I mean, one key thing to remember is that you cannot completely eliminate risk. You cannot make it zero. So your aim here is to only mitigate them, to manage them. Okay. So if I have to put it in one word, that word is diversification. Okay. Let me explain. Now, take the first risk that Vidya had talked about, which is market risk. That is the whether it is equity market or debt market, market is not performing well. There are three ways in which you mitigate this thing. You will already be aware of it, but let me just recap again. First, obviously, asset allocation. That is, you split your portfolio into equity and debt, depending on your own risk profile. And this will help contain both equity and debt market risks. So, by doing this asset allocation, if equity corrects, then your debt allocation or even your hybrid allocation comparatively will be holding up your overall portfolio on like an entire portfolio basis. Any loss because of equity is going to be compensated to some extent. You will keep the volatility lower, you will keep the losses lower, right? So first step, have the right asset allocation. The second is category allocation, by which we mean splitting funds, whether again equity or debt, in different fund categories in different market segments. So that will help you avoid the risk of one particular market segment not doing well, and therefore balance out your portfolio. So this is best explained in equity, obviously. So when I say market segments, I need large cap, mid cap, small cap. So if large cap is not doing well and mid and small cap is doing well, which is what we have seen for some time, that part of your portfolio is doing well. Or if the market corrects entirely, your small cap and mid cap are going to take a higher hit. Your large cap is not going to take that much of a hit. So because you're spreading it across, you're not going, overboard only on mid caps, or you're not going overboard only on small caps. That way you keep your risk of your entire portfolio lower. You're able to meet the market correction far better than if you just concentrated on one particular type of fund category or one particular market segment. In debt, how do you do this? In long term portfolios, what you do is mix up your fund types. So you have short duration, you have long duration, you have gilt, right? So when you have a long term portfolio, you invest across these different segments. That way, whatever the markets, the interest rate cycle is doing, there is one part of your portfolio, that is at least working, and it will compensate for impact in another part of your portfolio. The third is to be very correct in your time frame. By this, what I mean is, when you are deciding which fund to invest in, what portfolio to have, your time frame needs to be decided so that you match what funds you're taking or what categories you're taking to that time frame. Okay, so if you have, say, only a 3-year time frame or a shorter term time frame, you can invest only in low risk funds, money market funds, ultra short term funds, in equity savings funds. You don't invest in pure equity funds. So by putting your focus on time frame, you're able to address the risk of markets doing something and it affecting your portfolio. So these three, asset allocation, category allocation, being correct on time frame, this is something that we look at in our ready-made portfolios. So you can take a look at those ready-made portfolios and see, how there is a spread across asset allocation and category, or even in tools like the build your own portfolio. All these concepts are built into that particular tool. Okay, so that is your overall market risk. Now, the second risk that Vidya mentioned, which is your active fund risk. And what is risk in an active fund is simply underperformance. That is, your fund is, going to not match the benchmark return. Now, when you invest in active funds, you need to accept that there is always the risk of underperformance. Perfectly good funds can see one or two calls go wrong, which will impact their performance, and this performance can take a long time to recover, or it may not recover at all. Sometimes it could simply be the strategy that the fund follows, like value not doing well, or growth not doing well, or momentum not doing well. So when you invest in active funds, accept that underperformance is par for the course. Just like when you invest in equity, you know that corrections are par for the course. In active funds, underperformance is par for the course, accept it. Okay. So how do you mitigate this? First, in your portfolio, you have to mix funds with different strategies. So you have growth funds, you have growth at reasonable price, you have value, you have momentum, right? So once you have funds that follow different strategies, even if one particular strategy does not do well, or one particular theme does not do well, you have others that will make up for it, that will compensate for it. So this is something why in prime funds, which is our fund recommendations, we have a mix of these kind of strategies for this reason, so that you are able to build a more diversified portfolio. The second is concentration. Concentration in a fund, obviously. Don't let one fund form too much of your portfolio, 20-25%. When you avoid investing too much into one fund, or avoid letting one fund take over your portfolio, it limits the impact of any underperformance. If you have to, adopt a wait and watch approach and wait for performance to pick up, or if there is a fund manager change, all this, when you don't allow a single fund to have too much control over your portfolio, you're able to mitigate those risks. In concentration, you also have AMC concentration. Just like you don't allow a single fund to take over your portfolio, you don't allow a single AMC to take over your portfolio. Whether you're holding one fund from the AMC or 10 funds from the AMC, you do not have too much into the same AMC. And when I talk about AMC concentration, you look at equity separately and look at debt separately. Now, why is AMC concentration important? Because AMCs tend to follow, within equity and within debt, they tend to follow a similar overarching approach, or the core investment philosophy. So if there is any hiccup in that philosophy, it will tend to impact all the funds. They may be holding different stocks, but because that core philosophy is not working in that particular market, it is going to affect all the funds. We saw that in multiple AMCs, right, in the past. There were a lot of HDFC fund equity funds that didn't do well because they followed a value growth, buy and hold for the long term kind of approach. And then, as a sweep, they all picked up again. So that so AMC concentration is also an important factor. So both fund and AMC within your portfolio. In fact, this concentration point is something that is incorporated in our portfolio review tool, which reviews your mutual fund portfolio. This is one of the points along which it reviews your portfolio and gives you insights on whether you're too concentrated or not. Then the other way is to pick funds with good processes in place, or where there is clarity on how it is being managed. So, that way you're not entirely dependent on the fund manager making the right call or the wrong call or whatever it is. If there is a management change, again, it limits the impact if there is a process and a structure in place. But that is a little difficult to do, agreed. And there will be some funds, where the performance is brilliant, but you don't actually have complete clarity on what is happening. And, quant funds are a very good example. So these funds had very high churn. They follow a momentum strategy. Stocks are bought and sold very frequently. But so when you have funds like this, where performance is very great, but you're not very sure about how returns are coming, it could even be funds where some calls have gone very well, and the fund is performing very well and you want to invest in it. In these cases, you keep allocation lower, so that way you both get to participate in that return and you limit the impact in case something goes wrong. Which is why in prime funds, our fund recommendations, if there are funds like this where performance is very great but the strategy is not that clear, or it's just turning around or something like that, we clearly mention it and say, this is great, you can put it in your portfolio, but keep allocations low. Then the final way to balance your active fund risk is to add passive funds, right? That's the best way to cover. Underperformance is basically your fund not being able to beat your benchmark, right? So you hold the benchmark. So if there is any underperformance here, it will be compensated. Now, so those are the two main risks. Then you have the governance risk. So risks, so market risks, active fund management risks, these can be provided for in the way can be mitigated in the way we just explained. When it comes to governance, as Vidya said, it is unknown. You cannot predict which AMC will have what issue, right? You can go to some extent by the lineage of the AMC or the processes they have in place. But even this is not 100% foolproof, and we saw that in the case of Axis, for example, right? The second problem with governance issues is that its impact cannot be quantified, right? It can have a very big impact, or it can be completely, assimilated, taken into stride, and AMC will continue to perform, funds will continue to perform. Okay, so the nature of governance issue is unclear. Investigations into governance issues by the regulator can be long drawn, it can take time, it can affect the way the AMC is being run for that time being, how inflows come, how redemptions come, what that impacts on the strategy. Like Vidya was explaining, in momentum, in quant funds, for example, momentum is the strategy they follow. So if there is an impact in inflows, if there is an impact on redemptions, you know, this can happen. We cannot quantify it. We don't know if it will happen for sure. Sitting here, we will not know. So any impact, the fallout of any governance issue will always be clear only in hindsight. Okay, so we need to accept that this risk happens. But if you had followed already the entire diversification mitigation steps that we just explained in terms of asset allocation, fund strategy mix, AMC concentration, all of that, then any governance impact on your portfolio will be contained. It will be limited. It will not create such worry for you if there is something happening with your with an AMC, right? But when there is a governance issue, if it does transpire, then it is very important that you look at it objectively, isolate only that issue, and set aside any other perspective or bias that you may have. Okay. For example, again, let's take the current quant issue where there is, so much uh, fallout or so much angst over an exit call or holding on or whatever, right? If it had been, if the quant funds had been normal performers, not the superlative performance that we have seen, if issues had happened in other AMCs, if the same issue had happened in other AMCs where it wasn't, funds were not doing well, and such a front running issue came out, you wouldn't think twice about exiting the fund. You would have just done it, right? You wouldn't have thought so much about it. Why are you thinking so much about it? Because returns are high, and naturally you're unwilling to let that return go. You want to wait and watch and hope that things will improve. That is being biased towards returns. So again, in governance issues, nobody knows what the impact will be. If it does not blow over, the impact can be deep, right? So in such a case, it is always better to be conservative, to be safe rather than being solid, right? By switching your investment into other funds, you are not losing out, right? You will still earn returns. Yes, the new fund may not be as brilliant a performer as Quant is, but there is no guarantee that you have that Quant is also going to continue to do as well as it is, right? So take Axis funds, right? They had, I mean, that front running issue came up in 2022, somewhere, some mid 2022. From then to now, AUMs have gone up. They dipped for a while, they stabilized, but fund performance across the board has taken a severe hit. So funds, I mean, the fund ratings of many funds have gone from 4.5, 5 stars down to 1.5 stars, right? So there is no guarantee that waiting and watching is going to ensure that returns are going to continue to be high, especially when you don't know what the investigation or regulatory action is going to be. So waiting and watching you can do, but it can go either way, right? So it's important to know what kind of risk it is and then address it objectively. So for market risks, active fund management risks, diversification is the way to manage it. For governance risks, the better way to manage it will still be, to be conservative and to separate out what your fondness for the returns and what the issue actually is. Okay, so that is how you manage risks in your mutual funds.
Right. So Bhavana actually spoke quite a bit about the mitigation part. But if you noticed, I mean, if most of you viewers noticed, the last part of it on when it comes to governance is really a behavioral issue. You know, there is no such thing as the right behavior, the wrong behavior, but what would help you kind of conserve what you have built so far is the question that comes. So before we take on questions, I want to dwell a little more onto this behavioral issue. What we noticed, I mean, the first things first, many of you, many of our subscribers, or because unfortunately this thing that we had put out for our subscribers was picked by media. So there were a lot of questions and flags that we received. One of the very common things is that how can you put out a note when you do not know what is the outcome of this investigation, right? uh, so my question, or you should be questioning yourself, when the outcome of an investigation is fully known, right? If it is, I mean, there's nothing in it, well and good. But if something has transpired, you think, first of all, outcomes in terms of investigations don't come out very quickly, and they don't come out, with full details. You only know what the action that SEBI has taken. For example, there is a penalty of 2 crore or 3 crore, or exit of the persons involved if there was somebody involved internally, and so on, right? So now, when this takes a long while, and when you know that SEBI is continuing to investigate, the sense that the market or the investors get is something is really going wrong if an investigation is continuing and outflows start. So, how do you expect to wait for the end game to make your move? Right? So, that's one question that you have to ask yourself. Question number two, now your angst comes because many investors are overexposed to such funds. In fact, you know that prime funds had a couple of funds, and we were very, very clear when we gave that call that these should not be forming part of your core portfolio. They should be tactical calls, etc. Why did we have to harp about it time and again? Because we know this is not a strategy that can sustain, right? And a strategy that cannot sustain can't be part of your core portfolio. So, what went wrong with many of the investors who are really upset is that these funds start forming a large chunk of their portfolio. Even 10% is large in my view. So when that happens, naturally, one, like Bhavana said, you don't want to give up on good performance. When the going is good, why would I exit? And number two, the tax outflow, right? Um, and many of you wanted quantified whether the tax outflow is lower than the impact that I will have if an event transpires. If we could quantify, we would quantify. There is no way to quantify these governance issues until all the details, if they do come. And most occasions, they don't come out. Please understand. If they do come out, only then can it be quantified. If not, you do not, first of all, know what were the stocks on which front running happened. You do not know the price variation or the arbitrage that the person who front ran did, and therefore what was the imputed loss to the AMC, or if the AMC had bought from such a party itself, at what lower price could it have bought, and how did it impact your NAVs? These are questions that are 99.9% of the times unanswered, unknown, other than to the investigator, which is SEBI or the parties that SEBI brings in to investigate. So, with so many unknown factors, it is very difficult to say wait and watch. Yes, some of you had asked if it's a small proportion of my portfolio, is it okay? You should be okay. If you're okay, it's fine. I mean, if you are able to take the hit, if something happens, it is fine, right? So it's like going in a car. You're kind of you were told that this route is open and you can go. Although the locals warn you, Google says the route is open, the locals warn you that the route is 10 kilometers down the line closed. You can take a chance to travel those 10 kilometers, see that the route is closed, and come back and make a beginning again to the point from where you came. Or you can choose to take a different route, maybe slightly longer. It's the same with investment. Maybe if you are now switching to another fund, maybe it's not going to give you as high as return as quant did. For that matter, quant itself may not be able to repeat its own performance, right? So that's a call you have to take, and that's, if there is a hit, that's a call you'd be willing. Yes, a hit may not come by and you may be perfectly fine, in which case you are free to do that call. But we, as analysts, as watchers of the performance and the quality of funds, it is the onus is on us to call out, right? Nobody's pushing you, pushing this fund out of your portfolio. We are giving calls on the funds. You are taking a call on your portfolio. So that distinction, for example, if this one or two funds held were 0.1 or 0.2%, whether it's a fund or even a poor corporate governance stock, it doesn't matter. You take a chance, and move on, because the rest of your portfolio compensates. So those are the cases, that's a call that you should be willing to take. But in general, prudence. So all the three risk mitigation factors that Bhavana said, had one put in place, it wouldn't have mattered much, really, right? So that is where this kind of simple investment strategies help you retain sanity at the end of the day with a portfolio. Two, please remember, no manufacturer or no distributor who is, and I'm being very open about this, who is earning his commission from a fund will give an exit call very easily, right? We have the advantage of not having it in the first place. I mean, we are going to just look at a fund for its worth. Where we are not able to take a call, we tell you, hey, we are not able to take a call, and therefore we have to err on the side of conservatism. So this distinction is very important for you. I mean, we do know many of the flag that we received were from distributors themselves who were disturbed by, because naturally investors question them back, right? Um, so this distinction and this, kind of being able to differentiate performance and risk, right? And not everything that performance has no risk, and not everything that has high risk will give you high performance. So, and therefore there is a need to kind of keep them distinct and look at it for their own sake, right? So that's some kind of message that I wanted to give. Bhavna will probably take some of the questions that are here.
Yeah. So the first question we'll take from, we had sent a Google form and asked you to fill that out if you had any questions. So from there we have a question from Bala. I'll just read it out. Front running must be a common feature for all AMCs where they are handling thousands of crore of money. Now Quant has been singled out for such a crime. I am wondering all other AMCs I am wondering whether all other AMCs are envious of their growth in terms of AUM and returns on investment. Uh, well, I don't know whether there is a conspiracy theory or something against Quant, so there is no point in us speculating over what other AMCs are viewing Quant to be. We can only go by the news reports of the investigation, and if SEBI has conducted an investigation, then there has to be reason behind it, because search and seizure operations don't happen on whim or just on rumors or something. There is concrete evidence that something is amiss, let's say. So we don't know the depth again, who and all are involved in that front running, yes, but uh, whether other AMCs are doing it, I highly doubt that. I don't know that.
Yeah.
Okay.
So
So
also,
we
let's keep in mind, just to add that despite its very high growth, Quant is still very small compared with the
yeah.
giants that we are dealing with. So I don't think they would be too worried about the kind of growth that Quant is having. The second thing is, I'll actually club it with another question I saw, Bhavna, which is how are search and seizure operations different from
Yeah.
normal inquiries? See, normal inquiries, SEBI has enough access and regular filings by mutual funds to SEBI. So normal inquiries don't happen. They ought to be filing, dozens of stuff out there, and also putting it out in the public. Actually, make quite a few. So search and seizure happens when SEBI has evidence, especially uh, because they can catch many of the trades on the system when there is close movement, especially in low float stocks, of buying and selling and any kind of circuitous thing, and there is reason to believe that they are connected. That is when SEBI actually takes it up and starts, kind of formally asking for many of these questions. And if they still find little more evidence, and then they carry the books, that's when the search and seizure happens. So it's a very elaborate process. So in all this, this is not a free market, uh, friends. We need to understand that. I mean, this is a high, we are running in a very highly regulated environment. So it's not like one competitor hitting the other and so on, which is very common in e-commerce or any other trade, but not in this regulated entity where every single move has to be justified in general. I mean, when you're doing something, so it's not like somebody would have done this just to kind of put Quant under the radar, etc. That's very unlikely. But yeah, next question.
Okay. So the next question is, uh, for investors whose goals are 20 years away, do they need to worry about quant mutual funds underperforming in the short term? I think we have explained this quite thoroughly, especially Vidya in her last segment when she was explaining. She addressed this point was more or less. So ultimately, it's a call that you have to take. From we are taking this exit call based on the information we have currently and being conservative, and because you cannot quantify what the loss is going to be, if there is going to be a loss. We don't even know whether quants returns the way it is performing now can continue performing in every market cycle. So this particular market is conducive to something like a momentum strategy. Will it always be conducive? We don't know. So if the funds are a small part of your portfolio and you're willing to wait it out, that is a call, that entirely that you have to take based on what you what your
Mhm.
portfolio is. Okay.
This was this question from Arun Saxena.
Yeah, just a
Thanks for the
minute.
webinar. Yeah, I redeemed when your call came. Arun's question is whether the money redeemed can be put through SIPs or lump sum. In general, you can actually look up in our articles in our website. We have spoken about when you can do lump sum. So when you're investing in the same asset class and you're just switching, so you stay invested in equity and you're moving again to equity. The market risks are the same. There are no timing risks unless you're giving a gap. There is no timing risk. A lump sum would not matter. What you were holding in A, you're now going to hold in B. The market remains the same. Day one, second day, you're holding the other fund. So lump sum is fine. But if you're very worried, I mean, there's budget coming up, should I do, should I not do, you can keep out, set aside a small sum if you want to deploy for any correction and go ahead and kind of redeploy. But the risk with the second thing is sometimes people delay the redeployment. So when you delay the redeployment, then compounding is impacted. So far you were compounding in A, now you're going to compound in B. But because you're doing this delay, which is why we don't advise long sips between the two, because you've already grown your money. Your original cost was the cost at which you had invested. You've grown your money, you're just going to shift it. Now, if you start it all over again, you're again going to disrupt compounding because you're putting smaller sums through SIP. So SIP doesn't really work in these cases. If you're very you're particular that there might be a correction you want to deploy, set aside a small sum and then shift the rest.
Okay. So we'll go to the next question on within a core and satellite portfolio. If you diversify across many funds, there is a risk of having too many funds. No, we are not saying diversify across funds within the same category. We are saying across equity and debt, and within equity in different categories, within debt in different categories. When you have a large portfolio, you will have a higher number of funds. So that is a balancing act that one has to take, because if you have very few funds in a portfolio of several crore, then the material impact of fund underperformance is going to be huge. So when you have large portfolios, you need to have different more number of funds, and it's actually easier to have this style diversification in larger funds instead of smaller funds. You can add thematic funds, you can add these differentiated the passive funds and all that. So it's fine to have more funds in your portfolio. If you want like a ballpark figure or something, you can go check our articles. We would have written we have a specific articles on how many funds you should hold in your portfolio, and what kind of allocation you should have. So you can go and check that out for a more specific answer.
Right. So
I didn't
there's
show
one
that question. Is
question.
it? Oops, sorry.
No.
Okay, which one are you picking now? Sorry.
So I'll look at this allocation Parak Parik Flexi Cap. So we
Uh-huh.
have Mohit Yadav who has said, uh, that he has allocation to Parak Parik, SBI Mid Cap, Axis Small Cap, etc. Is this portfolio good for the long term? See, in all this, no, I mean, you might have for 10 years, 15 years, 25 years. Your asset allocation should ensure that there is enough downside containment whenever that happens, right? When I say downside containment, your asset allocation should have enough large caps, your asset allocation should have some debt, And then it can have some allocation to mid and small. If mid and small starts dominating your portfolio, whether it's a 10-year, 15-year, 25-year, when the fall happens, it is very steep. So your portfolio has to work that much more harder to come back to normalcy. So please keep that in mind when you build a portfolio. I mean, I do not know what is the proportion of your portfolio, but in general, you know, risk, higher risk category, small, mid, cannot be a large portion of your portfolio.
Okay. The next one from Praveen on Axis. Yes. So when we talked about Axis, what we said was the returns have completely fallen off the peak that they were in. So whether this was because of the front running, whether the way the fund management changed, whether it changed is not something that we are able to comment on. But it was more along the lines of if you followed a buy and let's wait and watch approach, if when that issue happened, it's no guarantee that those good returns are going to continue to sustain. So if you take the top performing Axis funds, which would have been Axis mid cap, small cap, blue chip, growth opportunities, all of them are severely underperforming both their benchmark and the other funds in their categories. So in our ratings, in prime ratings, they have gone from 4 or 5 stars down to 3 stars, 1.5 stars, and all that. So that is simply the performance taking a complete hit. So waiting and seeing what happens can go both ways. Performance can completely take a hit, in which case you're left with poorer funds than before, or it can improve. In Axis's case, it didn't improve.
Right.
Okay.
So
The
the
next one,
next
Marun
question.
Ramachandran.
Yeah. I like the concept of multi-cap fund to flexi-cap fund, but my concern was over-diversification because of number of stocks held. Motilal as a new fund where stocks will be less than 35, would this be good? You needn't worry so much about that, in my view. I mean, you can actually very simply use our mutual fund overlap tool, and you will know whether your fund overlaps are minimal. We ourselves in prime funds, when we give funds within a category, our moderate risk category or aggressive, we try to give funds with differentiated strategies. So when we give funds with differentiated strategies, naturally their portfolio overlap is also lower, right? So you should focus on that instead of looking at just the number of stocks and whether a new fund will therefore be okay. I don't think you should take any call with new funds unless you have seen a track record, and there are enough combinations you can choose with minimal overlap, so you should not worry about overlap, and therefore choose a new fund.
And if you're worried about overlap, you can use the MF portfolio overlap tool. We have one. So you just use that tool and figure out which of the flexi cap funds or multi cap funds in your list don't have a high overlap. So,
Hmm.
it's only when your overlap goes over 50, 55, 60% that there is risk of duplication. So if it is 30% or 40% or something, it won't really matter. The next question from
Anil
Anil
Kriplani.
Kriplani. Why were you not able to flag any material risk? Well, these are risks that, I mean, front running in an AMC, if we knew about it, it becomes public knowledge, right? How will we know some governance issues like these, where it's very internal, where SEBI also uh, finds out only through its investigations, is not something that anybody can predict. We can only go by portfolio level risks and strategy risks. So, in quant funds also, we saw their performance, their brilliant performance, but we also knew how that performance was coming because of that high churn and because of that momentum strategy that they were following. So the risk, we know realize the risk, and that is why we said don't have a high allocation to this fund. You keep allocation low so that you gain from the opportunity of whatever returns that fund is giving. But if anything transpires, if this performance is not able to sustain, if the market cycle changes, that risk is going to be compensated, or you'll be able to manage it. So that's why we are saying in governance you cannot predict it, you cannot quantify it, you can only handle it when it comes. And if you had followed proper simple portfolio building methodologies, it will not be such a worry. Whether it happens in
Yeah.
quant AMC or any other AMC that comes in, it should not be such a massive point of worry in a portfolio.
What we could highlight to you, and we did it amply, was the liquidity risk, the strategy risk. And therefore, we actually created a new category called tactical. If you would all go back to some of our quarterly reviews and read, we didn't even want to house this in the regular aggressive. We thought it was more than just aggressive risk. When we say tactical, it means it may not find a permanent place in your portfolio, right? So, to that extent, the systemic errors, not the errors, the systemic risks in the AMC we could identify. Naturally, these kind of issues, like Bhavana said, would be hard to. We have Mr. Modern Zen asking us, will you start recommending quant funds again in the future? Let's say if front running couldn't be proved, or if quant funds keep performing better, right? Um, so to answer your question, we had, let's just go back. We had the big issue happening with Franklin. It was not a governance issue to us; it was a fiduciary responsibility issue. Franklin chose to close his funds, not allowing investors to take money. The fundamental promise in any fund is to take out your money when you want in an open-ended fund, and they broke that. So we chose to kind of remove our ratings on Franklin. And please remember, Franklin funds, we had already highlighted the risk before the event transpired, because this was not a governance risk, it was a credit risk, credit event risk. So there we were not rating it. After the entire event fully completed, we started rating them back, right? With access to, it's not like we removed rating, we were continuing to do. With quant 2, we will continue to do our rating, there is no doubt about it. Quant in its current form and strategy will never find a place in the primary part of any of our portfolios. If its entire strategy changes, it says it's no longer momentum, it's going to have a very different strategy, we might. Why would we close our eyes to such an opportunity? But in its current form, it cannot. We may bring it back as some tactical, take small exposure, but unfortunately, I would have to put this squarely back on investors. Although we harp about be careful, don't take exposure. The moment you see returns, you tend to take high exposure, right? That really we cannot help. So with quant, yes, we will wait and watch. We will continue to rate. We will see what happens. And if performance sustains in a different cycle, and please remember, quant has largely seen a single cycle. We would keep our eyes open, but in its current strategy, like I said, it will never form part of. We will never say it should form part of a core portfolio.
Actually, that answer, I mean, what you just explained also answers this particular question. Being too conservative may be harmful. So, when we are saying conservative, we don't mean don't take risk at all. You need high risk funds because they give high returns. There is no way you're going to get high returns without taking on some risk. All we're saying is be careful in your allocations. So you take risk, you add high returning funds, but you don't go overboard on them. Okay. When Where does conservatism come in? In issues like quant specific governance issues where it is not possible to quantify or predict what the impact is going to be. In such a case, we will be conservative, right? So it's not conservative in your fund choice or your allocation or anything. If you have a long term time frame, put 80% in equity, have a high small cap or mid cap allocation. I mean, high as in not 60-70%. You have that mid cap allocation, you have high risk funds. Just be careful in how much you're putting in each of those funds. That's all we need.
Right. We have Arun Saxena asking us, are you planning a momentum small case? I'm using your consumption small case. Congratulations on using
Thank
consumption.
you.
I think it's a very good theme to be investing
Team
in
to be
right
in.
now. We are very kind of positive about the consumption theme in the medium to long term, actually. Momentum small case, unlikely.
Yeah.
The cost of running such a portfolio is high for us, high for you. And essentially, it involves us going well beyond our comfort zone in terms of always giving you stocks that are moving up, which when the tide turns, they say, who's naked. So it's like that. So when momentum falls, you cannot sustain performance in such cases. We are looking at other options, Arun. We might at some point try to look at technicals to give calls individually, but not a small case. So that's where we are. um,
Okay.
yeah.
So, uh, is front running the tip of the iceberg? Yeah. Okay. So we have another question with achieve financial independence. Well, achieving financial independence, I mean, that's very individual depending on what your income levels are, what your expenses are, and all that. So it's not easy to just give one broad sort of answer to that. Uh, you need to see what your incomes are, how much you're able to save, what your expenses could be, what your goals are if you have children for education. I mean, so there are multiple goals or financial needs that you have. So it is very individual specific. It's a call that you have to do based on your uh, existing investments, where you're investing your income, and how much you can save and all of that. So there's no one stop answer. Yes, it can be achieved if you're investing intelligently and saving intelligently, and you have the
Correct.
right expectations in mind. Yeah. Okay.
So I think the
So
same person is
yeah.
asked about the front running tip of iceberg. That's a very very subjective and a very long discussion,
Yes.
actually speaking. So there's no one answer to it. But one thing that I can tell you, see, we will not. I would definitely say we have a regulator. I would go ahead and say a regulator who is extremely cautious and sometimes over regulating. Being regulated ourselves, I can definitely tell you. So whether it's something that will burst, etc., I think it is like asking whether there are a lot of corruption issues in the country. So is it just the tip of the iceberg? Will the country continue to grow? Right? In spite of all the corruption activities that have happened in the country, the economic growth is very real. The economy has grown, companies have grown, the stock market has grown. It is like that. I mean, there can be front running cases here and there. We may never be able to find out, but more and more technology used by SEBI, to catch even these minute price differences is bringing these cases to light. And the more such high technology that the regulator uses, the fear of uh, committing such actions will come down. That much I can definitely say positively. So, but you shouldn't be worrying about it. I think at least the growth that we are seeing in the country is real. The growth that you are seeing in companies' balance sheet and P&L is quite real, and that has to reflect in your stock prices, and that is the reward you are getting for investing in them. So, look at it that way. These are but distractions that periodically happen. We have one last question, maybe, Bhavna.
Yeah. Okay. This is, sorry, which one am I seeing? Okay. Sorry.
Okay,
Sorry.
you can take Dinesh Trivedi. It's fine.
The momentum index fund, yes. So we actually have a very detailed article analysis written on all the factor indices and their performance. So you can just head over to Prime Investor, our site, and just look up. But generally speaking, momentum in factor index, in passive factor index, the indices that are uh, built using momentum have tended to do better than the parent index. So in all these factor index, you have a parent index like the Nifty 100 or Nifty 200 or something, and then on these stocks you have certain metrics that are applied, and then this other factor index is created. So you have to look at performance of that factor index against the parent. So is it able to deliver better than the parent? In the momentum 30s case, yes, the momentum index has captured upsides very well, but again it is high, it's a highly volatile index, so don't again go back, don't invest like your entire portfolio or something like that. Keep allocations limited, but yes, you can continue to remain invested in that.
So I'll probably take the last question
Yeah.
from NRA Armugam Ramaswamy. He has invested in HTSCMF because it's the only AMC office available in Dubai. Is there any associated keeping? Like Bhavana said, it is best to diversify, not because we doubt HDFC AMC right now, but because the strategy you are narrowing into one fund house's strategy, one fund house's practice of investing, which is quite similar across funds. So it is good to have a mix of AMCs to get a mix of different fund management strategies, right? But if you're the kind who's just going to invest in index funds, it doesn't matter really. I mean, if you're going to have in multiple funds, as long as you can check our own index ratings to look at the ratings are good index fund ratings, because we take into account tracking error, the expense ratio and so on. If that is so, then it's fine. But otherwise, I mean, even if you are living in Dubai, you have sufficient online platforms, and if you are using Prime Investor, and you should if you're not, you know, uh, you have the funds out there, the recommendations. You can go for a direct platform and invest. So there is very little reason why you should be worried about having an AMC office, in this day and age.
Yeah.
Please go ahead, take Prime Minister subscription and invest confidently. I think that should solve your problem. I mean, especially if you're an NRI. So I think we're coming to the
We
end
have
of
no
the
more questions.
Q&A. Two more?
No, we
Uh,
have no more
no
questions.
more, right. So before I conclude, and Mr. Armugam Ramaswamy, even stocks is something that NRIs can invest in. We have prime stocks also that if you wish to take individual stock exposures, and that's something that I want to tell people. I mean, if you decide to take risks, try to take risks, I mean, for high returns. I mean, don't upset your core portfolio of mutual funds, long-term investment. Try to take small exposure to stocks, and keep exposure contained. That is also one way to kind of up your overall portfolio returns. We have very good calls in prime stocks. We have, in fact, a series of calls done in the past.
Right.
We are trying to rejig our strategy post elections. So you will see, a good number of calls coming up. So you should look up at them. And for mutual funds, even if you don't invest, exactly in the ready portfolios we have, try to understand the construct of the portfolio. That will help, like Bhavana said, kind of contain your risks and have a mix of strategies and so on. So those are a few things I thought you could do. And for those of you here who just registered with us and are our trial users, I wish to tell you that we are happy to provide a discount with a coupon code called Prime Now. So please take it and invest, subscribe to Prime Investor, invest wherever you wish to, and we make sure that we are giving you calls, buy calls at the right time, alerting you to issues such as these. The call is always yours. We are not going to hold your hand and say, hey, withdraw or hold back. We are not your distributor. We will never do that call. But you are free to empower yourself with Prime Minister and make the best investment decisions to grow your wealth. So with that, Bhavna, shall we close the session today?
Yes, yes. So if you have
All
any other
right.
questions, just mail us at contact and we'll see. Contact
Yes.
at primeinvestor.in.
Thank you.
Okay,
So if
thank you.
we had not answered any of the questions, please write to us like Bhavna said, contact at Prime Minister. And please use this coupon code that is live to subscribe to Prime Investor. Thank you and have a wonderful weekend.
Thanks, everybody.